Hi, welcome to the next instalment of the Fiducia webcast with Michael Hughes. I'm Kearney, Director here at Fiducia, and it gives me great pleasure to welcome Michael, our economist. Michael, our previous interviews identified some medium-term themes. Could you summarise what these are now?
Well, there's been three themes that have underpinned our thinking in the last 2 or 3 years. The first is that the world is going through a period of deleveraging. The debts that have been built up by the previous generation are now having to be repaid, and that will obviously depress economic growth for quite some time. The second has been the era of financial repression, and what we mean by that is that the interest rates that governments are paying on their debts are lower than inflation. So from a saving perspective, you have a negative real interest rate because governments are having to deal with their debts by trying to limit the amount of debt servicing that they're having to pay. And that again, I'm afraid, is something that we will be living with for some time to come. And the final thing, which perhaps is a more positive theme, is that the emerging markets, which clearly have got the potential to grow, but much more importantly, they've got the firepower to give their economies a boost, should it be necessary to do so. They don't have the debt, so they can use cuts in taxation or increases in public spending to boost weak economies, and they clearly have got the ability to reduce interest rates to a degree that we clearly can't do in the Western world. So those have been the three themes that have been underpinning our thinking in recent years.
On the last point, are you speaking specifically about China, or are there big players that come to mind?
No, it's really right across the emerging world, because if you look at the average interest rate even now in the emerging economies, it's about 5.5%, and that compares with only 0.5% interest rates in the Western world. So you can see that there is scope for them to reduce their interest rates, and they are clearly beginning to do that.
Okay, thank you. Back in the spring, you were rather nervous about equity markets, and indeed there was a correction in the second quarter. What's your position now?
Well, the reason we were concerned then is that we felt that economic growth, and particularly corporate profits, were going to be a negative surprise over the spring and summer months, and indeed, unfortunately, they were. And so we had something like a 10-12% correction in stock markets in the second quarter. But as we've gone through the summer months, we have started to put a bit more money back into markets, very gently perhaps, partly because we felt at some stage later this year, economic growth would actually start to show signs of life in some parts of the world, not all by any means, but at least it's better to have some signs of life than none at all. But also we felt that the valuations that you were beginning to see in some markets after that 10-12% correction actually gave us an opportunity to buy into longer term better values.
Okay. And in terms of recent data, there's been positive data from China. What impact do you think that's going to have in the short to medium term?
Well, the two sets of evidence that we've had recently, which has suggested that economic growth may be recovering into the new year, are firstly the house builders in the United States, where you've seen a very sharp turnaround in house building. Now, houses, like in the UK, are a big part of people's spending, and so if they feel more confident about putting more money into housing, and the house builders are obviously building more houses, that is a pretty important sign. And so consumer confidence in the United States does seem to be improving. The other thing that's happened, and partly because of that I suspect, is that the trade data in Asia, which had been pretty depressed over the summer months, suddenly shot back in September, not just in China, but more relevantly in Korea and in Taiwan. And if these areas, which are big exporters, not least the United States, are increasing their number of exports, again it's a sign that perhaps we're in for a slightly better spell in terms of economic news than the rather depressing news we've had for most of the year to date.
And what other factors are sort of formulating your thinking at the moment?
Well, there are three things really. The first is the complete lack of political leadership. Obviously the European situation is unresolved. All we ever see from them is the European Central Bank buying time, hoping that one day European politicians will actually fulfil the vision they had for a single currency. But that is yet to come. So there's a political vacuum in Europe. We have a change in leadership in China. So most of the big policy changes are more likely to take place next year than before that leadership change. We have a degree of political turmoil in Japan, probably leading to another election there, and indeed similarly in India. So in very major parts of the world, quite apart, of course, from the American election, which again is pretty uncertain at the moment, all those suggest that the politics is not going to be a big positive factor for a while. So that concerns us. The other two things that I think are relevant are that the whole investment universe has had one big theme for the last 18 months. They've not trusted governments, but they have all said you must invest in defensive, large-cap, safe companies. And that indeed has been a theme that's paid off. But if you look at the valuations of these companies, they're now pretty high, and hence it may not be appropriate to be pushing quite so defensively in the large cap defensive space as it has been right to do so in the last 2 years. So we've been looking for opportunities away from that.
Is that UK and global, or more specific to the UK?
No, it's very global. That is, or very large cap developed world global, because people think that these are the companies that have got the cash flow, they're paying dividends, they're conservatively managed, they have better credit ratings than many governments, all of which is true, but that fashion for these stocks has led to their valuations proving to be somewhat excessive. And the final thing, which I think is a theme worth noting, is that I think as we've gone into 2013, there have been two big policy mistakes at the end of 2012. The first has been from the United States, where they have introduced another round of quantitative easing, money printing, but on a scale that potentially is bigger than the first two, and probably unnecessary. Because of the improvements that we're already beginning to see in the American economy, I think that they will find that they have done too much. And far from the markets believing the Federal Reserve that interest rates aren't going to change until 2015, or not before 2015, I actually think that the evidence that we will be seeing in the early part of 2013 will be that the markets will believe that interest rates have to start going up again much, much sooner. So that's something to keep an eye on. And the other policy mistake, I think, has been the French budget. Because the austerity measure that's going into France, we're quite familiar now with the austerity measures in Portugal, in Ireland and Greece, but the degree of the austerity measures placed in France and the timing of it, when it's already in recession, I think risks putting France into a vicious downward spiral, which again will be a negative development to keep an eye on for next year. So there are some positives and some negatives to take forward, but I think where we are trying to position ourselves is for a different set of risks for the year ahead than the ones that we've been trying to manage in the last year.
Okay. Just finally, on geopolitical risk, we've had the skirmishes between the Chinese and the Japanese over the islands, and also with the ever-looming issues in Israel and with Iran. Do you see those as a threat panning out in the next sort of 12 months, and what impact it will have on markets?
Well, I don't think the Chinese-Japanese thing is something that's going to escalate. Okay. I think both have got elections or changes to leadership potentially, which will allow people time to get to know each other and not do anything too much. I think the Iranian-Israeli one is actually more serious, not least of the impact it potentially could have on the oil price and hence on living standards worldwide, but because of the implications it would have for that region generally. So that is a very genuine risk, and one which in terms of interpreting from a portfolio perspective is one that we have to be very sensitive to.
Okay, well, thank you very much for your time today, Michael. That's all for this quarter's webcast. I'm Gordon Kearney from Fiducia. Thank you very much.